Welcome to Online Trading Campus. This is Jan Skoropinski with you today, continuing the new 2020 Forex course. Welcome to Module 2 Beginner, Lesson 1 Global Forex Markets. This is the agenda for today. At first, we will look at the various currency pairs and group them into three Forex categories, so-called Forex classifications: majors, minors, and exotics. After, we will spend some time investigating the importance of the US dollar and how we can use the US dollar as an additional zone qualifier, as an anchor point to help us with our decision-making process. Forex pairs can be classified into three different groups. We have so-called majors, minors, and exotics. Majors are currency pairs that include the US dollar. These are the most liquid currency pairs as they show the most trading volume. For example, the Euro USD, the GBP USD, the USD JPY, or the USD CAD. Cross pairs or minors are currency pairs where the US dollar is eliminated in the equation. They are pairs that include non-USD majors. For example, Aussie CAD, New Zealand JPY, or Euro CAD. Other very popular minors are Euro JPY or Euro GBP. These two pairs have become so popular and are traded so frequently that some brokers have included those two within their own major currency pair lists. And lastly, we've got the so-called exotic pairs. Exotic currency pairs are a combination of any major currency and another currency, mostly consisting out of a wide range of developing and emerging market economies, or just markets that are very thinly traded, like the Swedish krona, the Polish zloty, the Mexican peso, or the Turkish lira. These we would refer to as the most expensive and costly forex pairs that we can trade. They mostly come with wide spreads as well as high rollover costs. What we also have are precious metals in form of currency pairs. The symbols for those pairs are XAU or XAU for gold and XAG or XAG for silver. Most brokers will offer these precious metals to be paired against the reserve currency, the US dollar. So the tradable symbol would be XAU USD and XAG USD. Equity and other brokers will also offer XAU and XAG to be paired against other widely traded currencies like the euro, for example. So XAU euro or XAG euro. We will, however, stick to the US dollar pair, as this is one of the pairs we can look at professionally in terms of futures gold charts and futures silver charts. Now here's the interesting part. When it comes to trade execution, we can either trade them through a Forex pair like XAU USD, which would come with all the Forex specifics like daily rollover costs and no expiry, or through so-called future CFDs like GCZ20. The difference is, one you can technically hold forever without expiry, yes correct, the Forex pair, and the other one, the futures product, you will have to worry about expiry. But there's no daily rollover charge. So trading large sums via futures is always going to be the cheaper option, but also the one we need to be more educated for. But don't worry, this is something we will look at in more detail once we talk about CFDs later on. For now, I just want you to be aware that we can trade gold and silver through our Forex brokers in different forms. Here's a good cheat sheet to sum up the different Forex pair classifications. Majors, the most liquid and widely traded currencies against the US dollar. Minus, a combination of non-US dollar majors, eliminating the US dollar from the equation. Exotics, very thinly traded currency pairs with wide spreads and high rollover costs. And of course, gold and silver in form of currency pairs. coupled against the US dollar, the global reserve currency. In the beginning, we want to trade markets that are extremely liquid, low cost, and offer medium volatility. Liquid and low cost in terms of spread and rollover costs, and medium volatility, so we have a lot of movement potential to meet our income objectives. Therefore, in the beginning, I want you guys to focus on major currency pairs. This is your starter pack major pair watch list. You have the euro, the yen, the cable, the Swissy, the CAD, the Aussie, and the Kiwi. Notice that some currency pairs either have the US dollar as a base currency or as the quoted currency. Whenever you have the US dollar as a base currency, like for the USD JPY, the USD GIF, and the USD CAD, you are basically looking at the inverse Japanese yen, Swiss franc, and Canadian dollar. Meaning a stronger Japanese yen means falling prices in the chart, and a weaker Japanese yen means rising prices in the chart. The same principle applies also to the USD CAD and the USD GIF. Whenever the US dollar is the quoted currency, like for the euro US dollar, rising prices means stronger euro and falling prices means weaker euro. As beginners, we want to master majors first because majors are the most liquid currency pairs combined with a medium average volatility. They are a great way to ease into Forex trading and understand price action and how the different pairs generally move on different time frames. The characteristics in terms of low cost, high liquidity, and medium volatility make them the perfect tool for all income types, also daily income. Once you advance and master majors, you can move to minors, and after minors, also look at a few exotic pairs, as per your choice. Here you can see a list of minors that are recommended in the beginning. Euro JPY and Euro GBP are the most widely traded minors. They offer the most liquidity and also volatility. These are so-called high volatility markets. Other products are the Aussie CAD, Euro Aussie, Pound Yen, Pound Swiss, and the Aussie Yen. This is just a list of 7 minor pairs. Of course, you'll be able to add and remove as per your own preference. We only recommend trading minors and exotics using weekly and monthly income timeframes. Daily income is not recommended for minors. Here is a summary on our income objectives in relation to the Forex categories. Majors are great to ease into Forex trading as they are the most liquid pairs, offering medium volatility and low cost trading opportunities. Hence, they can be used for all income objectives, also daily income. Now, minors are more advanced as they are known to be extremely volatile. At the end of the day, however, it will depend on what kind of a trader you are and what your preferences are. Are you looking for very fast-paced and extremely volatile market moves within a market? Then Euro JPY and Euro GBP and other minors are probably right for you. Are you looking for less volatility? Then Euro USD and majors are the right vehicle for you. In the beginning, I do not want you to rule out currency pairs. Trade as many as you can, and with experience and logging your trades, you will see for yourself which currency pairs work for you and which ones don't. The only recommendation I have is to stick to higher timeframes when trading minors and exotics, weekly and monthly income timeframes. And lastly, let us not forget XAU USD gold and XAG USD silver. These are tradable using all income objectives. Now you may be rightfully asking, well, what about the US dollar? Yes, the US dollar is the modern day version of the gold standard. As you learned in the first lesson, until the 1970s, the dollar was valued against the ounce of gold. And then Nixon, as we talked about, took the US dollar off the gold standard, and today we have what is called the US dollar index. The US dollar is the most heavily traded single currency in the world. The US dollar is still the currency that is used most in international transaction, and it is commonly held as a reserve currency. Now, the US dollar's value is tracked by comparing its performance against a basket of 6 foreign currencies, basically the US's most significant trading partners: Europe, Japan, Canada, UK, and even Sweden and Switzerland. When I'm on TradeStation, I usually use $DXY as a symbol, and the actual future symbol for the futures contract is @DX. And when we type in @DX equals 103xN, we will get the unadjusted chart of the US dollar index that continues even after the rollover and expiration date, something you will learn in the futures course. When I'm on equity, I will look at the US dollar future CFD, meaning when we want to trade the US dollar, we have to know the rollover, expiry, and future specification of the contract to be able to trade the US dollar on its own. And while this is part of the futures course, we will also spend a little bit of time on that once we cover CFDs and future CFDs later on down the road during this FOREX course. Here you can see the weight of the currencies within the US dollar index. Look at the euro value weighted against the US dollar. It is pretty heavy weighted, right? 57% of the total weight of the US dollar value. So basically like a sports rivalry, FC Bayern Munich versus Dortmund, or if you watch baseball, Red Sox versus the Yankees. So just looking at this, you could assume that the Euro USD chart is merely a mirrored image to the US dollar index. So when we are looking at the dollar index chart, we are looking at the opposite of the Euro USD chart. Then we have the Japanese yen with 14%, the British pound with 12%, the CAD with 9%, and even the Swedish krona and the Swiss franc with an approximate of 4% weight of the US dollar index. Historically, the US dollar can be seen as a safe haven during times of global recessions. This is because investors would pull money out of other markets like stocks, assets, or other global currencies they may be holding, and they transfer this money into cash, US dollar cash, because US dollar is the global reserve currency. Investors would rather hold US dollar as opposed to other global currencies that may seem riskier at the time. You can see that during the last recession, the housing crisis of 2008 and 2009, the US dollar index experienced a massive spike. Then the chairman of the Federal Reserve back then introduced the concept of quantitative easing, or QE. For the first time in history, the Fed printed money and injected this into the economy. That was in March 2009. And if you look at the chart of the US dollar index, you can see that at that point, price was very high and in a high quality supply area. Because they printed a lot of dollars, around 3 trillion US dollars at the time, the value of the dollar dropped massively. And the buyers then would come in at monthly demand in wholesale, driving the price of the US dollar up. The Fed has a job, and that job is what is called a mandate. The first mandate of the Federal Reserve is price stability of the US dollar. From 2012 all the way to 2014, the Fed have done a pretty good job as they have flattened the volatility of the US dollar, which they believe would in turn stabilize the economy. When price of the dollar skyrockets because investors are scared and are pulling money out of the system, then the Fed, through QE or quantitative easing, is taking dollars and they are putting it back into the system. In essence, they would then go ahead and invest these freshly printed dollars in a lot of creative ways, including buying bonds or equities. And as they inject these dollars into the economy, it drove the price of the dollar down. The Fed's mandate number 2 is full employment. So after a while, price stability of the US dollar was achieved through what was called QE1, QE2, and Operation Twist, which basically had to do with refinancing of loans. Loans that were due in 3 to 5 years could be pushed out into 30 plus years. So what is really the problem now at that time? If you're a consumer in the US, even though you have price stability, well, the US dollar has been devalued. It's worth only 80. At that point, Janet Yellen was appointed the new chairman of the Fed. She was known to be a labor hawk, so she cared a lot about the second mandate of the Fed, full employment. Her argument, if we can help the consumer have more buying power, then they will go to the mall or to Amazon.com and buy more stuff they don't need. So Yellen, in her first 6 months of being the new chairman of the Fed, achieves the US dollar index rally all the way up to 100. How? Well, she simply threatened to start raising interest rates, basically saying, we're not going to print more dollars. If the Fed says we're not going to create supply of US dollars anymore, well, what does it leave us with? Only demand, until price goes up and meets new supply. Now, do you think that prices are random or controlled? Look at this. First of all, old supply became new demand as price rallied up to 100. The interesting fact is that when the US dollar index was first introduced in 1973 after the Bretton Woods Agreement, the value of the US dollar index was set at 100. At this 100 mark, you also have a lot of high quality fresh supply, and guess what? From this supply, the US Fed starts money printing again, creating more supply of the dollars, and therefore price also drops from this monthly supply area. Pretty fascinating stuff, right? The reason I'm spending so much time on the US dollar is because I believe in using the US dollar as an anchor point and decision-making process as a Forex trader. And I also believe that the Fed is looking at a similar technical chart analysis framework that their decisions are guided by. We need to understand the narrative and use our supply and demand analysis to guide us, basically give us a roadmap on the charts telling us whether we are turning right or left at any point in time. So how do we create that narrative in our mind that then will allow us to make a decision? Well, we simply use our blueprint strategy. Is price low or very low on monthly time frames? In my mind at this point, it is okay to be a buyer. Is price high or very high on monthly time frames? In my mind, at this point, it is okay to be a seller. And of course, what is the trend on a monthly time frame? Am I seeing higher highs or lower lows to be formed? Can I see an impulse to the downside or an impulse to the upside? And therefore, in 2014, for example, do we know that price is going to rally from 80 to 100? No, we don't. We never know for certainty what the future holds, but can we position ourselves along with the opportunity because all of the signs and conditions are in place that would point towards an upward movement of price? And all of this with low risk, high reward, and high probability, with a chance to see price rallying to this extent. Ultimately, Yellen's threat back in 2014 to raise interest rates merely confirmed the technical decision that you and I should have been making back then, way before, to position ourselves to go long the US dollar. So when we are looking at the charts, even if we knew nothing about the story, the bigger picture context that we are getting in terms of higher time frame supply and demand location and direction tells us the story. I'm just using the story of the US dollar to relate to you guys. Now we said that we want to use the US dollar index as an anchor point to help us in the decision making process when trading Forex, especially when trading our major pairs, which we know are paired against the US dollar. The most obvious one is the Euro USD, which we already established is the reverse mirror image of the US dollar image due to the high weight within the US dollar index. This is what is called an inverse or negative correlation, basically meaning that these two products or markets move the opposite. If the US dollar goes down, the Euro USD goes up, and vice versa. There is a long-term consistent relationship between the two. On the right side, you can see the Euro USD, and on the left side, the US dollar index. As you can see, both markets trade similarly. On the 31st of March 2020, the Euro USD reacted to monthly demand, and in the same time frame, the US dollar index reacted to supply. While the relationship between the Euro US dollar and the US dollar index is the strongest, we also see similar effects happening on other majors. Therefore, we can use the US dollar as an additional zone qualifier when trading major pairs. As a general rule, for majors with the US dollar as a quote pair, like the Euro USD, Aussie USD, New Zealand USD, and GBP USD, we want to see US dollar in higher timeframe demand when shorting, and we want to see US dollar in higher timeframe supply when buying. For majors with the US dollar as a base currency, like the USD JPY, the USD CHF, and the USD CAD, we want to see US dollar in higher timeframe demand when buying, and we want to see US dollar in higher timeframe supply when shorting. Here you can see a good example within the same time frame we looked at the Euro USD before. During the end of March, beginning of April 2020 timeframe, as you can see, the Aussie dollar is reacting to monthly demand, while the US dollar is reacting to monthly supply. Therefore, you would be trading in the ideal context of the US dollar index, trading the strongest currency versus the weakest currency. This concept will also be applicable to trading majors versus minors, as minors are a construct of two non-US dollar major currencies. This we will talk about in more detail once we get to the correlation lesson. Alright everyone, today we covered quite a lot in terms of global Forex markets we can trade using our Forex brokers and the importance of the US dollar index as a single trading instrument. Up next, Module 2 Beginner, Lesson 2 Margin and Leverage. I will catch you all for the next lesson. Thanks everyone, and until then, happy and safe trading, and ciao.